This is when you sell your gold and silver. Hi, I'm Mark O'Byrne, the Research Director of GoldCore.com, your precious metals delivery and storage specialist. And in this week's video update, we're going to consider something that it's actually one of the most overlooked and least considered aspect of the precious metals market, and indeed investing in precious metals and buying precious metals. And it's something when we do questions and answer sessions and webinars and interact with clients on the phone, it's one of the biggest questions people have. So we said we should look at it again because it's very, very important indeed. Everyone thinks, oh, when should I buy gold? When should I buy silver? When's the best time to buy? But an as important question, if not more important question, is considering the exit and when do you actually sell? So it's something we've looked at a bit over the years, but we always feel like we need to look at it more and consider it more because it is very, very overlooked. So just before I came on the video here, I jot down a few sort of things that are sort of indicators, shall we say, of when you would consider selling your gold and silver. And it's important to I suppose distinguish. We're not saying that there's a perfect time to buy and there's a perfect time to sell. There's not, and nobody has a crystal ball. And when we say sell, the other thing is to qualify. We believe that you should always have a core position in physical gold coins and gold bars, allocated and segregated in your name in the safest jurisdictions and the safest vaults in the world. So you'll always have that core position, but there is a place for actually when markets become overvalued and potentially go parabolic, and this tends to happen particularly with precious metals, and we've seen very clearly in 1979 and January 1980, there will be an opportunity to actually take profits on some of your position. So if you have a slightly higher allocation of precious metals, and say you have 25-30% of a portfolio in precious metals, there is a place for reducing those allocations towards the top of the market, but while maintaining that 5 or 10% physical allocation in precious metals. So just that's an important caveat. We're not saying you buy now and you sell later. It's not about capital appreciation, not about solely about return per se, but it's for some people it is a consideration, and I think they're right. And I think one of the lessons we learned in the last bull market was that people should have taken some profits towards the top while maintaining that core position. And I think if they had done, they would have been much happier. And it's something that we're going to be focusing on in the coming months and years, and helping our clients and subscribers, but more so our clients, to navigate the choppy waters that are ahead, and to help them exit their portfolios at optimal times. So, and one thing to say on that is we continue to tell people to dollar cost average into position and geometrically cost average into position, which is you acquire your fundamental core position and then you gradually accumulate the rest of the position, and you apply the same principles when you go to sell. So you will not decide, or you should not decide, today is the day, this moment I'm going to sell it all and do very well indeed, because nobody knows. There's so many variables. So you should apply the same principles, and potentially you'll be selling some of your position over a period of weeks and months near the top. So I'm going to focus more on the sentiment, because we think that's a fundamental thing, the cycle of market emotions, and that's a key thing to consider when you're going to sell and you're considering selling. But I want to also just briefly look at some sort of indicators of when you should sell. I jotted down a few before we came on. And the first one that I wrote down was when financial and monetary crisis is over and a degree of financial and monetary stability prevails. So we're on record in recent months. We believe we're on the verge of another global financial crisis, a global debt crisis. Global debt is over 250 trillion, and the global debt to GDP ratio is over 300%. We've covered this quite a bit on podcasts and in recent months, and it's a real risk. And at some stage there will be a crisis due to this, a debt crisis, and that will impact the banks, the financial system, the sovereigns, the entire system, and that's what creates a systemic risk. So you have to have your financial insurance, and you should have higher allocations in precious metals until this happens. When this happens, it's going to take a period of weeks, months, potentially years before the system rights itself. And as I said, we return to some form of fiscal and monetary stability and normality. And it will likely take a long period of time. But before that happens, it would not be prudent to start selling the financial insurance that you own in terms of your physical precious metals. So that's one consideration. The next one I wrote down is when the massive global debt bubble has burst and the debt burden is eliminated, so or greatly reduced. So the debt will be either eliminated through inflation, or indeed we will see some form of debt write-offs, a form of debt jubilee, whereby governments internationally decide to wipe the slate clean. But more likely is that they will print money and the debt will be eliminated through inflation. Another indication will be when banks and sovereigns are not massively indebted and vulnerable. So people are not going to leave their money in banks if they believe the banks are vulnerable, and they're more likely to have higher allocations to precious metals. So when banks, particularly in the Western world, in the UK and Ireland and in the US, are in good financial shape, and most of them today are not in good financial shape, then people are more likely to leave their money on deposit. And if that's the case, then precious metals will be less attractive and vulnerable. Widespread confidence in fiat currencies today. There is increasingly less and less confidence in fiat currencies, and we see that obviously in terms of cryptocurrencies, Bitcoin. This is why these cryptocurrencies have become very popular indeed, because people don't trust the existing monetary system of fiat currencies. So unless we get some degree of confidence back into fiat currencies, and that may come about through a return to some form of a gold standard, and that's what might actually instill confidence in these currencies again. It will take that, or at least take politicians and central banks that people trust are going to manage the economies and manage the currencies in a much more prudent manner than they're doing today. And three other things to consider: gold and silver reaching their all-time inflation-adjusted highs. This is something we covered on the video recently. Bull markets tend to end in assets reaching nominal highs and inflation-adjusted highs, and we're a long way from that today. Gold-silver ratio returning to much lower levels. In a bull market of gold and silver prices, the gold-silver ratio tends to fall quite sharply, and you tend to see it fall back down to, the last bull market was 15-1. So gold ratio 15-1. Gold was 850 and silver was 15, and that's another key indicator to look for. Gold and silver looking expensive versus equities, financial assets, and indeed property markets. Today, property markets, stock markets, bond markets, all-time record highs around the world. Gold and silver prices look very depressed indeed, particularly after the most recent counterintuitive sell-off, and it looks quite a manipulative sell-off once again. So when stock markets have had serious corrections, or indeed bear markets, and property markets have had serious corrections and potentially crashes, and you see value in those mainstream assets, and gold and silver prices are higher relative to these assets, then this is the time that you will be reducing allocations to precious metals and rebalancing your portfolio into these undervalued assets. And the final thing, and one of the most important things that I think you need to consider, is gold and silver tend to do well in either negative interest rates or when there is a lack of yield on deposits. Today there is no yield on deposits, so gold and silver will be vulnerable towards the end of an interest rate tightening cycle, when banks are in good financial shape, and when depositors and pensioners and people around the world are actually getting a decent yield on their savings. In that environment, then gold and silver become less attractive, and deposits obviously become more attractive, and the miracle of compounding interest. But again, that's looks like it's 3, 5, 7, 10 years out at this moment in time, So that their big picture, a few things I just jotted down beforehand in terms of things to consider. But one of the primary things is actually sentiment, and I'd like to share with you. Oh, sorry, I've already shared the screen with you. Yeah, so this is something we've looked at over the years and created this cycle of market emotions. That's a very good indication of where we are in the cycle. We gave this in a presentation to clients recently, and we looked at it, and we basically said we are in moving from depression to hope. And I think there was a bit of hope there in recent months, and arguably we've gone back down towards depression because we're back below $1,300 per ounce on gold, and nearly $15 per ounce on silver. So gold and silver have had a hard time, and sentiment towards them is very, very poor indeed. And that tends to be a good time to buy. Conversely, when gold prices have gone up and silver prices have gone up quite significantly in the coming months and years, as we believe they will, and we get into a new bull market, then the sentiment will slowly turn, and they will move from hope to relief to optimism. And then when gold prices have gone up and doubled and trebled in value, then people will get excited and they'll start telling their friends and their family and telling people, listen, you have to buy precious metals, you can't lose. It's going to go much, much higher. It's already doubled in value and it's going to triple in value from here. It's going to go to 10,000, 20,000, 50,000, whatever forecast people have, you know. That's when you get into the irrational exuberance, as Alan Greenspan coined the phrase, when people just become very, very, very confident. That's the time when you should be reducing allocation of precious metals, and that's what good contrarian investors do. They do the opposite of what the crowd is doing, what the herd is doing, and they go against the group psychology. It's quite a hard thing to do, and particularly because it depends on the wider market backdrop and indeed a systemic backdrop. And if the system is very vulnerable, it will be quite difficult to reduce allocations to. But I think there'll be lots of different indicators, and we'll be guiding you, and we see ourselves as watchmen on the wall, and in terms of alerting our clients to these various risks. So that group psychology is something to consider. And when everybody is buying something and they think you can't lose, this is, the no-brainer, you can't lose with this investment, the price is going to go higher because the demographics, because of the fundamentals, it's guaranteed to go higher. That's when it will be time to slowly be reducing your allocations while maintaining that core position. And this is seen in all markets, in stock markets and bond markets and property markets. And indeed, it was seen in the gold and silver market, particularly in the late 1970s, but also to a degree in 2011, 2012 with gold and silver. So one of the classic examples of this herd behavior and group psychology is the famous Business Week front page from late 1979, when they spoke about the debt of equities. And this was after the 1970s, when there was massive stagflation, inflation throughout the 1970s, and in effect the stock market from 1970 to 1979 in effect went sideways. The Dow Jones was roughly 1,000 in 1970 and roughly 1,000 in 1979, and it was a hard time for mainstream investors who invested in equities. But those who diversified into precious metals in the late 1960s and early 70s did very well indeed, because gold prices went up from $35 to $850. So they went up to 20 times plus. So as you can see here, the Dow was at 833 in August 13, 1979, and this Business Week, one of the biggest, I think it was the biggest financial publication in the world at that time, and they basically said the stock market is dead. And this shows the degree of negativity investors were. It was capitulation. They had given up on this asset class, in effect, and this nearly, not quite, it didn't quite mark the bottom, but it wasn't far off it. It actually took another 2 years of basing, in effect, and sideways. But a bottoming out process can take a long period of time, and I believe we've seen a similar dynamic in gold actually in the last 2 or 3 years. Gold since 2015, 2016, 2017 appears to be slowly bottoming out and consolidating at these very low levels in euros, dollars, pounds, and there's a similar trend taking place in the precious metals as we speak. It bottomed, and then within 5 years, 1984, it had nearly doubled. It was up at 1,250, 1,300, and then 10 years later, by 1989, we were up at above 2,000. So it had doubled within 10 years, and then it really took off. Over the next 20 years, obviously we were up at over 10,000 by 1999. So this is a classic, and there's lots of these. This isn't just one example of that sentiment, and how sentiment can go from being irrationally exuberant and very, very positive to extremely negative. And when sentiment is very, very negative indeed, that's a good time to buy. And we see that in the gold market recently. There's, for 2 or 3 years, the mainstream publications have been very negative. They rarely cover gold and silver, rarely cover gold, nearly never cover silver. And when they do cover them, it tends to be quite negative, particularly big mainstream financial publications such as The Economist, which is had a headline 2 or 3 years ago akin to this, actually, basically talking about the debt of gold, and how nobody was buying gold, only the Russians were buying gold, and gold was on its way out, as a barbaric relic. So that sentiment has been very poor for a long period of time now, and that's a strong suggestion that we have bottomed and we are going higher. So, and there are many, many examples of this throughout recent financial history that show this, the herd behavior and the group psychology, and how the massive investors tend to get it wrong. They tend to buy high and sell low. They tend to have extreme confidence, irrational exuberance near the top of markets, and then be very bearish and nervous near the bottom of markets. And they tend to do the opposite of what they actually should do. So there's a few more examples of this here. I mean, these are different recent financial history, mainstream publications. Money, tech stocks, everybody's getting rich. And this is in 1999. This is, when you should actually be reducing allocations to tech stocks in 1999, because they'd had a massive run up, and there was a bubble there, obviously, and the Nasdaq burst very, very badly indeed. So there are other examples of it there, and when you see a very negative headline, high anxiety, the crash, that was after November 1987 is the time, the crash, Time magazine. That was actually a great time to buy stocks, because stocks had actually just crashed at that stage, So again, it underlines the importance of being contrarian and tending to do the opposite of the mainstream sentiment. So when there is a publication, a mainstream publication in the world says everybody's getting rich in gold stocks, as an example, or in gold and silver, and here's how you have to buy gold and silver today because the price is going to go higher and you're going to get rich, obviously that would be a time to be nervous about gold and silver, and that'd be a time to reduce your allocations while maintaining that core position. And when everyone's telling you to, when everyone's telling you to do something, and that's the mainstream sentiment, you should consider doing the opposite of it. I mean, at this stage, most of you know who we are, what we do. Just in case you don't, these are sort of some of the key performance indicators, if you will, and key facts about GoldCore. But the main thing that we've specialized in is allowing people to own physical precious metals, coins and bars in the safest way as possible. We deliver internationally. We have clients in over 140 countries, and then we allow people to own gold in what we believe is the safest ways possible, allocated and segregated, fully allocated, fully segregated physical precious metals ownership. So yeah, bottom line, I think the key thing again is just to go back to this chart here. I just think it's so important and so powerful. When there is a lot of positivity towards precious metals, and there is people that are just believe they're going to get rich. When there's more greed than fear, today there's nervousness about precious metals. Will they go lower? I only spoke to a client there an hour ago saying, I'm concerned there could be deflation, there could be a Lehman Brothers crash again. I think in the short term they might go lower. Will I wait? And I said, listen, we don't have a crystal ball. Just get your key position, get your core position, and then when there's dips, continue to buy and buy on the dips, and that's what you should be doing. Keep stacking. The stackers have it right. And then conversely, in 3, 5, 7, 10 years time, whenever it is, we'll have a better idea once a lot of the stars are aligned in terms of some of the things that I've spoken to you about today. When that happens, when gold and silver prices have hit record highs, it's on the front page of Financial Times, it's on Bloomberg TV, when we're on Bloomberg TV more frequently and we're on the front page of Financial Times, and what we do is sexy and it's the topic du jour and people are talking about it and it's in the news and it's topical, that's when it will be the time to start reducing your allocation of precious metals. And when you see it's at an all-time record high and it's on the front page of newspapers, that's a time that you should be considering selling some of your gold and silver. And we will be helping you with that process. And we take great pride in assisting our clients in regards to these things, because unfortunately it doesn't tend to be something that's covered very frequently in the mainstream. So thanks for your time. Any questions at all, feel free to send us an email, reach out to us, and yeah, look after yourselves. Take care. Thank you very much. Bye-bye.